Hello and welcome to Money Unshackled News, the headlines. Proposed capital gains tax hike scrapped by Rishi Sunak. The Office of Tax Simplification had previously suggested it should be aligned with income tax rates. Mortgage lender Accord Mortgages, part of the Yorkshire Building Society, will no longer require a minimum income for buy-to-let landlords, opening the door to potential investors. Previously, landlords had to earn £25,000 in addition to rental income.
AJ Bell to launch free investing app called Doddle in acknowledgement that commission-free trading is the future. Interactive Investor will be sold for £1.5 billion to British fund management giant Aberdeen. CEO promises customer pricing will remain the same.
You can now get up to £50 cashback in thousands of shops without buying anything. More retailers are expected to join as Cashback without purchase scheme is rolled out further. In a move seized by the UK government as a post-Brexit vote of confidence in the City of London, Royal Dutch Shell will move its headquarters and tax residence to the UK and change its name.
We've gathered all the latest money news from the past few weeks that matter most to your finances. If you find this financial news bulletin useful, then hit the like button and let us know down in the comments. Let's check it out.
And by the way, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. There are thousands of stocks to choose from and they charge zero FX fees when you trade.
Instead, Stake converts your pounds into dollars when you deposit money, so you only incur FX fees once, rather than every time you trade, as you do on many other apps. Stake are giving away a free US stock worth up to $150 to everyone who signs up via our offer link, linked to in the video description below. Let's kick off with a financial rarity, some good tax news. Rishi Sunak has shelved the proposal to hike capital gains tax, pointing to the burden it would place on HMRC. Interestingly, the burden it would place on the public wasn't mentioned as a motive. At the end of 2020, the Office of Tax Simplification proposed to the Chancellor that the capital gains tax rate should be aligned with income tax.
Capital gains tax is charged at 10% for basic rate taxpayers and 20% for higher and additional rate taxpayers, with rates of 18% and 28% on residential property. In contrast, income tax is charged at a basic rate of 20%, rising to 40% and 45% for higher and additional rate taxpayers. Therefore, an alignment of these tax rates would be a major blow.
From the moment the tax hike proposal was made, we thought it was utter madness. In our view, as a minimum, everyone should have the ability to preserve the buying power of their financial assets. But with inflation constantly nibbling away at the real value, and then a huge tax payment of up to 45%, we can't imagine anybody would want to attempt to build wealth and prosperity in the UK, as this tax would simply punish success.
Hargreaves Lansdowne commented, there would have been huge unintended consequences of the proposed CGT changes because people would have been artificially trapped holding assets they didn't want because the tax benefits of hanging onto them until they died would have been too good to lose. This would mean, for example, buy-to-let investors refusing to part with properties they didn't really want in an effort to avoid CGT, while first-time buyers struggle to get on the property ladder.
It was also proposed that the capital gains tax annual allowance was lowered, but thankfully this suggestion has also been put on hold. Perhaps the worrying part of this proposed tax hike being scrapped is the reason given, with wider policy trade-offs and the burden on HMRC being cited. There seems to be no concern for doing the right thing. We fear we haven't heard the last of this story.
In other good news, that's 2 out of 2, so don't expect many more. Accord Mortgages, the intermediary-only lender of Yorkshire Building Society, will no longer require a minimum income for buy-to-let landlords. Previously, a landlord would have needed to earn at least £25,000 on top of any rental income to qualify for its buy-to-let mortgages. The move is designed to help more landlords to qualify for its mortgage products.
However, in cases where landlords are using earnings from outside of their property portfolio to top up any shortfall in the rental calculations, Accord will continue to specify a minimum income of 50 grand per year. Generally, first-time buyers might struggle to buy a rental property if they don't already own their own home, but now, on a case-by-case basis, Accord will also consider lending to first-time buyers who want to become landlords.
According to The Telegraph, Accord has followed NatWest, which eased its rules earlier this year. Around a quarter of lenders now no longer require any minimum income for borrowers to qualify for a buy-to-let mortgage. The relaxed requirements will particularly help retired freelancers, consultants and business owners, as well as those with smaller pensions who were previously blocked from getting a loan because they lacked the annual income to qualify.
It also means that somebody who may never have earned good money but has still managed to build up a large amount of equity in their own home could release some of that equity and start investing in buy-to-let property.
We're on a roll, so let's keep the good news flowing. AJ Bell appears to have conceded to commission-free investing with the planned launch of a new app called Doddle. The name might be silly, but the fees will be competitive with the existing commission-free apps.
There will be no dealing fees, but there will be an annual fee of 0.15% of the portfolio's value, with a minimum of £1 per month. There will be no additional charges for the use of a tax wrapper, so it will be amongst the cheapest providers for ISAs, LISAs and SIPPs.
AJ Bell is aiming to launch Doddle during the first half of 2022. The disappointing news, however, is that Doddle will have a very limited investment range. The platform will offer just 50 UK shares and 30 funds at launch, with aims to add US shares later down the line. Frankly, with such a small investment range, its launch might be a bit of a damp squib. AJ Bell are clearly struggling to make the shift to commission-free investing in one fell swoop, probably in fear that it will cannibalise their existing business.
Over in the US, all the major players swiftly cut their trading commissions to zero in order to remain competitive. We have long expected the UK market to do the same, but equally thought it would take some time. While we don't think Doddle will be a game changer at launch, the competition is heating up, which is only good news for us as investors. As we always say, fees matter, so you've got to keep driving them down.
In other investment platform news, Interactive Investor will be sold for £1.5 billion to British fund management giant Aberdeen. Following weeks of speculation of a deal, the board of each firm said Aberdeen would purchase 100% of Interactive Investor's share capital, including those owned by its majority shareholder JC Flowers.
Aberdeen said that the direct investing market has grown at an annual rate of around 15% and is expected to continue growing at a similar rate in the future, driven by accelerating demographic and structural market trends.
In an email customers received, Interactive Investor stated that pricing will remain the same. We are committed to our transparent fixed fee subscription pricing. We're glad that the fixed fee pricing model won't increase, but following on from the last news point, we can only see downward pressure on their trading charges. If they don't eventually take an axe to those commissions, surely they will begin to hemorrhage customers to the platforms that do.
We're not privy to the finances of Interactive Investor as it was a private company, but the increasingly intense competition between platforms forcing them to lower fees cannot make the platforms good investments themselves when they have such sky-high valuations. For example, Freetrade have just undertaken a fresh round of funding, which has valued the company at £650 million, which is an eye-watering sum considering the company is projecting an adjusted loss of £26 million. The new valuation represented a multiple of 13 times projected 2022 revenues, never mind profits.
In our last news episode, we reported that in the past 5 years, 660 banks per year were closing in the UK. With closures expected to continue at pace, this would obviously make it more difficult to access cash. Moreover, thousands of cash points have disappeared during the pandemic, with many not being replaced. Around 8,000 ATMs have been switched off in the past 18 months, according to research by consumer group Which, equating to a loss of around 13% of all ATMs.
Personally, we're not too fussed about access to cash because we, like most younger people, have fully embraced the cashless society where we can. In fact, shops and businesses that don't accept card annoy us way more than the limited access to ATMs does. But if you still need cash, fear not, because you can now get up to £50 cashback in thousands of shops without buying anything. Earlier this year, the government relaxed rules on shops offering cashback.
Under EU law, a business wanting to provide cash to customers had to register with the Financial Conduct Authority, a lengthy and expensive process, but new post-Brexit deregulation cut that requirement. More than 1,000 retailers are already part of the Cashback without purchase scheme, with 1,000 more expected to join by the end of 2021, according to The Sun.
In another Brexit win, honest, we didn't plan this, Europe's biggest oil company, Royal Dutch Shell, will move to London and change its name. Royal Dutch Shell announced a major overhaul of its legal and tax structure, but will see the company walk away from the Netherlands. Shell will drop its complex dual share structure and move its headquarters and tax residence to the UK.
Shell said the simplification was designed to strengthen its competitiveness and accelerate both shareholder distributions and the delivery of its strategy to become a net zero emissions business. Shell's decision to quit the Netherlands follows similar exits by Unilever and Relax. According to Sky News, part of the impetus for Unilever's move, and it is thought that of Shell's, is the 15% withholding tax levied by the Dutch government on dividends paid by Dutch domiciled companies.
Under the current arrangement, holders of Shell's A shares pay the tax, but payments for the B shares are routed through Jersey, avoiding the tax. In March this year, however, the Dutch government announced plans to tax dividend payments to low-tax jurisdictions, which would mean the tax would also apply to B shares. This may well have concentrated Shell's mind.
As part of the move, the company will be forced to change its name since it will no longer qualify for royal designation. Subject to shareholder approval, the board expects to change the company's name from Royal Dutch Shell plc to Shell plc.
Question of the day. Do you care that cash machines are disappearing? And what do you make of Shell becoming British? Join the conversation in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.